Am I live? Am I live? Hey man, what's going on? What's up? How y'all doing? We are back. We are back, man. I'm so excited and happy to be back with you guys. It was a long summer. The last couple months has been really, really busy. And, you know, we kind of got away from the channel for a little bit. I was traveling for work, doing a bunch of things, and I wanted to take some time, get myself together, and get this thing started back again, right? So, over the last couple months, been to Wisconsin for work. Then I end up going to Virginia for work also. So I've been away from home for a little bit. Was so busy trying to get things done, trying to get things started. Wasn't able to really get the channel popping on a weekly basis as I usually do. But I will say though, we back now. We are back finally. Financial Blueprint is back. And as we move forward, I got this new journey starting, and it gives me more opportunities to come and talk with you guys and tap in. We did get a new camera. We got a new microphone. We got some new things coming. So moving forward, what this channel is going to continue to be, and this show is going to continue to be, is we're going to actually advance more into twice a week. We're going to continue to have our financial conversations. We're going to continue to pour into you when it comes to the information, the knowledge, the understanding. And we're going to have some stock market updates. So the plan for me moving forward is to do more, do more, give more, provide more, and hopefully we'll see what the outcome is in the future, right? So I appreciate you guys tapping in with me. We are going to look at some stock market stuff today, as well as looking at the Fed speaking today, earlier this morning. What I want to say is, man, continue to support the channel, hit the like button, subscribe to the channel, share it with someone that needs it. We can always get better when it comes to our financial journey, our financial literacy, our financial knowledge. It's very important that we move forward when it comes to learning and developing more into our investing journey, as well as just our basic fundamental financing when it comes to our daily life. All right. So what has been happening this summer, right, with the stock market? In the spring, we seen tariffs. The president of the United States hit us hard, hit countries hard with extremely high tariffs. And the goal, in my opinion, was a negotiation tactic. And we seen the businessman that is Donald Trump, regardless of how you feel about him personally, right? The businessman in Donald Trump put himself out there to take a risk when it came to putting tariffs on countries to negotiate deals. And what we have seen is that exactly happened. There has been deals around the world. Japan, the EU just announced a new deal. Other countries have announced a new deal. China and United States have been in communication about a trade deal. And the president put tariffs that affected the stock market in a negative way. But we have seen over the summer that the market has went from very low to what we've seen as new highs consistently over the last 30 days. And we have hit new highs, I believe, 3 times over the last 30 days or so. We have reached all-time highs in the stock market. Right now, though, we're at an inflection point. Usually in the fall, there are market seasonal trends, right? And we are hitting one right now. You have a run up that happens during the summertime, and you have this period of time in the fall where you have people taking vacations in August, and then school starts when it comes to kids going back to school. And there's this lull that happens between August and September every year. It seems like, if you look at the history of the market over the last 10 or 20 years, there's this lull in between this August and September timeframe that creates a low volume environment where people are not investing nearly as much. And we're getting into that currently right now. And then you increase it with the political pressure that Donald Trump is putting on the Jerome Powell, the Fed chair, to lower interest rates. We've seen it over the last couple weeks, right? He's looking to criticize the Fed chair to lower interest rates to what he believes should be at least 100 basis points lower than it currently is right now. How is interest rates affecting, getting loans as well as buying a mortgage and buying a house? It is not impacting the market when it comes to the stock market, but it might be impacting the economy when it comes to the United States. And the average borrower, the average, American might be feeling the effects of inflation and interest rates, right? So we have a few things happening. We have political pressure from the president. We have seasonality when it comes to investing in the stock market. We have inflation that reached a little higher than it was expectation. PPI last week was high, which means that tariffs, we haven't seen inflation hit the tariffs, impact inflation until last week, which was the July report for PPI. So the Fed's mandate is low unemployment and lowering inflation. Currently, right now, we had a little bit of higher report when it comes to the job numbers, and we had a little bit, higher inflation when it comes to the PPI. So the Fed chair has to make a decision in 2 weeks. Does he keep rates currently at their rate that we are currently right now, or do we lower the interest rate to 25 or 50 basis points? Right. So political pressure, inflation, seasonal trends, the employment, as well as the market reaching an all-time high, and businesses as well as the president wants lower interest rates when it comes to the Fed chair. And then last but not least, we have his term is coming up, which is May of 2026, in which he no longer will be the Fed chair, and the president of the United States can decide who will be replacing him. So there's a lot of little issues that we have going on right now, all around the same time that we see seasonal trends of a possible downturn when it comes to the stock market. So what we're about to do now is we're going to take a look at a federal governor that is speaking on the current interest rate, the employment, as well as the possible decision to either lower interest rates or keep them as they're currently at right now over the next 2 weeks, going into that September meeting when it comes to the Fed.
You gave a recent speech where you said you thought the labor market looked pretty solid. Give me your thoughts on that.
Yeah, I think it is solid. I think relative to where we believe full employment is, the numbers look pretty good. And I think that there was definitely some cooling in the first couple quarters. Since then, literally within the last few days, we've met with folks around the district, and there's a lot more optimism going in the last couple quarters of the year. And so I kind of agreed with Chair Powell at his last FOMC conference that while the numbers seem softer, they seem to be in balance, kind of the supply demand.
Are you seeing in the data at all any impact of changes to the immigration policies?
You probably have to assume that some of the labor data was affected by some of those numbers. I mean, even the administration talks about the successes they've had relative to the numbers and the decline of the numbers from a year ago. So you would think that would be in the mix somewhere. But overall, with the supply and demand imbalance, we still came out with a 4.2 unemployment print.
So let's talk about the other side of the mandate, the inflation side. What are you seeing in the recent numbers?
It seems like that last mile is pretty hard. And I'm one of a lot of folks that believe that there's a real hard, true cost to that last percent of inflation that's in the system. I think that we might see a tick up. I would say that it's probably the inflation number is probably closer to 3 than it is 2. And I think we've got some work to do. I think we want to continue to figure out how we keep pushing that number down toward 2.
Markets have big.
Oh, let's stop for a second. You got to listen to what he said. So the Fed's mandate is to lower inflation to 2%. That has been the goal for the last couple years since we've seen the heights in inflation when it comes to the Fed. Currently, the rate is around around 3 or a little bit above 3. So when it comes to lowering interest rates, does it make sense to lower interest rates if inflation, one of the most important aspects of the Fed's responsibility, right? You got unemployment and you have inflation. Does it make sense for the Fed to lower interest rates? If inflation actually ticked up a little bit, right? It's been coming down consistently over the last 6 months. But if it ticked up a little bit in the month of July, some people say that it's based on tariffs, right? Should Jerome Powell in September lower interest rates? My initial answer would be no. Why would he lower interest rates if we are just talking inflation mandate? Why would he lower interest rates to basically succumb to political pressure from the president of the United States? His job is not to make the president happy, right? His job is not to make anyone per se, a person happy. His job is to get inflation down to a rate that they set when it comes to their goal, which was 2%. So this goes into our next conversation when it comes to the stock market, because the market is currently reacting to an 85% chance that Jerome Powell will lower interest rates in September. That's why the run had legs to a new all-time high, to where when CPI came out 2 weeks ago and CPI met expectations, a lot of people felt like, well, inflation's coming down, we're good to go when it comes to September rate cut. But then a week later, PPI was hot. So you got consumer price index, you got producers price index, right? The PPI was hot, showing that there were service inflation showing up in the data for the month of July. So if Jerome Powell is only looking to do his job, then I don't believe that there will be a rate cut in September. If he succumbs to political pressure, as well as some of the governors within some of the Treasury, governors within his, section say that he should lower interest rates, then he may lower it 25 basis points. But for about a year and a half, almost 2 years, Jerome Powell has been saying that we are looking to get employment, high employment, as well as, or lower unemployment, as well as lower interest rates to 2%. And we are not there yet. And what this gentleman is saying is that last percent, that last from 3 to 2, is a hard mile to reach. And if I'm reading what he's saying correctly, if we listening, I don't know if they're going to be lowering interest rates in September, which will affect the market in a negative way.
In the idea that the Fed is cutting rates in September, are they in a bad place now as far as you're concerned?
I think we've got a lot of data to harvest between now and September, and I think something will emerge where I think we'll start to see a little bit more definitive move one way or the other. Markets seem to be in good shape, spreads. So I think we're in a really good spot, and I think we really have to have very definitive data to be moving that policy rate right now.
So at this point, are you a person who could go either way in September?
We'll get around tables and we'll collaborate and we'll figure it out. But yeah, I think there's a lot to be said between now and September.
I'll just be honest, reading your last speech, you did not sound like a person who was in a hurry to cut interest rates.
No, that's probably fair.
You look around the economy and you don't see a whole lot of things that are restrictive out there.
Right.
What would tell you that there's restrictiveness going on, or that the Fed is overly restrictive relative to where it should be?
Yeah, I'm actually trying to find it. I mean, I really have been looking. I don't know exactly what we're restricting. I here again, the credibility of our anchoring on that inflation number to 2 is a very important piece of the dual mandate. I think we got to be careful about what lowering short-term rates would do to the inflation mentality, if in fact inflation is still running closer to 3 than 2.
We have a big day tomorrow. We'll have full coverage of Chair Powell's speech, and then we'll talk with Cleveland Fed President Beth Hammack on the Cook issue. We have asked the Fed for a comment from the Fed chair, and if the issue's been referred to the Inspector General. I also asked FHFA how they discovered the 2 mortgages that Cook has and whether other Fed officials are being investigated. Neither the Fed nor the FHA have responded at this time.
So this is an important conversation when it comes to what the Fed is going to do over the next couple of weeks. He said that the Fed's mandate, the dual mandate from the Fed, is high employment, right? Which means your employment rate stays lower than 4.5. All right. If you can get the employment rate around 4 on a consistent basis, then you're in a good place, right? When it starts to get up above 4.2, 4.3, then we start getting a little bit of a touchy, sensitive, space there, right? Which unemployment currently right now is locking into that 4.1, 4.2 range. So a lot of, there are some people that might say, well, it's time to start lowering interest rates because unemployment is starting to tick up a little bit. But it's not at a point where, it's alarm bells are starting to ring. However, interest rates is the second part of that. Inflation is the second part of that mandate, which is why the Fed has heightened interest rates and kept them higher for longer. So if we're starting to see hot PPI, we starting to see hotter inflation, then that more than likely means that there will not be a rate cut. Right? How does that affect your money? How we move forward when it comes to investing in the stock market has everything to do with this conversation. Right? Hey man, like I said, hit the like button, subscribe to the channel, and let's keep going, right? So now we're going to look at a chart. And what I want to do is I'm going to pull up the chart right next to, the conversation that we're about to have. Because this is in real time. In real time, we are looking at a current chart of S&P 500. And I'm gonna space this out to a 1-year chart. And you see some lines there. This red line that you see is the 200-day moving average. And as you can see, we took this big dip in April, and we have ran up since then. Usually the market will stay above the 200-day moving average when it comes to price. And we also have this yellow line, which I'm not sure if you see, this 75-day moving average, right? So 1-year out chart, we can see that the market was moving up, and then it had its really big dip in April, and now we are been running since then. And if we're going to make this a little closer, so this is 6 months from April all the way up, right? And as we can see, the market's been moving up. We had a dip a little bit in early August. We moving up again. Now we are back in our possible correction levels, right? 3 months out, as you can see it from a magnifying glass standpoint, the 75-day moving average, right? It hit it right here, which was in June. We ran up. It came back down a little bit lower than that 75 in early August. We ran back up, and now we are currently testing those levels again. Going 1 month out, a little bit of a closer magnifying glass. And every time you get closer, you start to see price movements, you start to see levels, and you start to see where the support and resistance levels are when it comes to technical analysis. And I'm not trying to I'm not trying to teach technicals right now. I'm only making the visibility of the stock market and how price matters and what these levels mean. It's very important that you understand when you are investing how seasonal markets move, catalysts when it comes to the stock market, interest rates, the Fed, all of it is important because obviously I'm looking at a bunch of red over the last week. And this actually started when we got the PPI report, which basically said that we have hotter inflation in the month of July and tariffs could be impacting inflation in a negative way, meaning higher inflation that has been manifesting through the market, through businesses, and ultimately to the consumer. And we may see more inflation. Again, if you go back to the Fed, the Fed's mandate is to get inflation to 2%. If we continue to see hotter inflation data, the market will not react positively because the market is assuming that we're going to get a rate cut in September. It's assuming, right? It is forward leaning in a positive direction that we're going to get that rate cut. But if that rate cut does not happen, blood in the streets. Blood in the streets. So the next 24 hours is very important because tomorrow, Jerome Powell has his FOMC minutes, which he will speak publicly to the United States, to the markets, to everybody in the world. Because again, the United States interest rates affect everybody around the world. And what he says in this meeting, in this 30 minutes to 45-minute press conference, could impact how the market reacts over the next 30 days. Again, seasonal trends say that the month of September is the worst month to invest into the stock market. The stock market drops on average a little bit above 2% annually in the month of September. So before we even start talking about, federal interest rates and political pressure from the president and inflation and all of that, the seasonal trends say first and foremost that investing at a high in August and then seeing the blood or the red that you see when it comes to the month of September is already weak. Going into it weak. So as an investor, do I invest at a high in August? No. Why? Because I know that there will be a downtrend, a little small correction, just seasonal wise, 2%, 5% on average, right? The market goes down 2% in the month of September. Now you start to add the other things like the political pressure from the president, like the inflation going higher, possibly, right, due to tariffs, like the interest rate staying higher longer than the market has been predicting, which is the possible, which you see up here, which is the red and the downtrend from those variables. What does that tell you when it comes to being an investor? You got to be careful right now. And I'm going to tell you right now, you got to be careful. Careful from the standpoint that you understand that there may be a 5 to 7% dip in the market over the next 2 weeks. You have to understand how the market moves when it comes down, seasonally when it goes down, as well as seasonally when it rides up. When do you make your money? It's the price that you enter defines how much money you can make. It's not the price that it goes up to. It's the price that the entry price. So if you know that there will be, because you don't know everything, but if you can make a educational, theory, a hypothesis, and say that the facts say that if we get hotter inflation, the Fed holds interest rates, the market will react negatively, which means that I can get into certain stocks, certain companies, as well as the S&P 500 as a whole at a lower price. So do I then invest currently right now? The answer is probably no. The answer is to wait, have cash ready to go over the next week or two to where you can see the impact of higher inflation, possibly, and the Fed holding rates higher for longer, and see the blood and take the opportunities that will come over the next 2 weeks. the opportunities will come. Because red for me is opportunity. It's not a negative thing. I look at all of this as a positive. The lower prices that I can buy stocks at, the more money I'm ultimately going to make long term. If you are nervous currently right now, then you need to continue to learn and continue to grow when it comes to your emotions and discipline in the stock market. It's not something that is easy. It's something that you have to train your mind and train your emotions to look at green as that's cool, but look at red as even better. Because every time I see prices go down, I look at it and say, okay, I can add to my portfolio. I can get more long-term options when it comes to certain stocks. There are opportunities that will come to continue to build my positions in certain great companies that I ultimately want to invest in long-term. But most importantly, do you have the knowledge? Do you have the understanding to be able to look at the data, look at the chart, and say, this S&P 500 is coming down to hit its 200-day moving average? Is it a good time the dollar cost average at the 200-day moving average? I would say most likely yes. Most of the time, dollar cost averaging at the 200-day moving average is a good idea. Right? Depending on the stock, depending on the market, depending on, a lot of different variables that you ultimately as an investor make a decision. Is it a good opportunity to invest at the 200-day? Yes, most times. Right? But if I'm looking at this from a 3 months out perspective, that 75-day moving average is a good time to invest also. So if you said to me, yo, Antoine, I want to invest today and I want to get into, the S&P 500 as a whole, is that a good idea? That's a good question. Only you can answer that as an investor. Am I investing in the S&P 500 today? No, because I'm actually looking for some more blood to happen. I'm looking for more blood. However, when these levels start to come, I am 1,000% taking advantage of a dip at a 5 to 7% possible range over the next 30 days. I am taking advantage of it 1,000%. So, today I wanted to take a moment to not just get back on the channel and start to, give out some good information, but to show a chart and actually provide some visibility on how you need to look at the market as a whole. You have to understand macroeconomics, how the political landscape is working, the trade deals around the world. How is that moving? How is tariffs impacting, not just businesses, but also to the consumer and ultimately long term? How is tariffs impacting inflation? Right? Is inflation going higher? Are you understanding what the reports are saying when the CPI or the PPI report comes out? Right? We have the Fed and interest rates and their dual mandate when it comes to employment as well as inflation. Are they going to lower interest rates? How is the market going to react if they do lower interest rates versus if they don't? How does that then impact your decision making when it comes to being an investor? All of these questions and answers, you got to think about those things. You got to analyze those things and ultimately make the educational decision that you can make when it comes to your investing journey. If you invested in April and you seen the low and I called it and I said, yo, that 480 level when it comes to the S&P 500 is a great level to invest in. And it hit 480. It hit the 480, I think 7 range, right? In April. Actually, let's see where. Yes, 481. 481. And I'm saying, yo, buy 490, buy 500, buy. And let's say if you bought in that levels at 480 to 500, you are up big time. Nvidia up over 90% from the 90. I think it got to 89. I bought at 93. And we made sure we had a lot of shares, right? At 93. And we up, Nvidia is sitting at 170, around 170 right now. We up over 90, 100% when it comes to certain stocks. If you invested in the S&P 500, you had 30 to 40% gains currently on the year. You're having a great year. If you missed out, September is always another opportunity. You look at the chart, you know what that 200-day moving average is. You see what the trends is in the different things that we got going on when it comes to the Fed, the president, things like that, and you make the decision ultimately for your investing journey. Right? So as we end this today, again, like I said, man, hit the like button, subscribe to the channel. We are back. Let's go. What I want y'all to do moving forward, on Tuesdays, we're gonna rock out and we're gonna learn. We're gonna give out great information. On Thursdays, we're gonna have a stock market update. We're gonna look at what's been happening. We're gonna plan for our future. We're gonna have some of those conversations. We might show the chart a couple times, and we're gonna rock out and move forward when it comes to that. Also, then we might get a video or two during the week where we just living and learning. We rocking out. What's the most important thing right now for you is to understand the details. Understand the details. And ultimately, in the end, what's most important is you got to execute. You got to execute at a high level. When the levels come and you see the market dip, you got to hit the button. Fear is not knowing what you're doing, according to Warren Buffett. It don't exist. Get your emotions right. Get your knowledge right. Execute at a high level. I want to just say, man, this weekend, actually today is Thursday, and I want to shout out, my guys down, that's going to Atlanta. Everybody that's going to Invest Fest, I'm gonna shout you out, man. Have a great weekend. I couldn't be there due to other responsibilities that I have this weekend. I really wanted to go, but I just want to say, man, shout out to Earn Your Leisure. Shout out to Ian Dunlap, Rashad, and Troy, man. Shout out to the family. Shout out to everybody that's going down to Atlanta to be a part of Invest Fest 2025. Have a great weekend, man. Network, do all you can, man. Learn as much as you can. Shout out to Red Panda and the community that's out here trading and getting to the bag. Shout out to all of the people out there, man. I love y'all. I appreciate y'all. Man, I just want to continue to give out the information, give out the love, and continue to pour into anyone that's looking to progress themselves moving forward. Hey, man, this is Antoine Smalls, Financial Blueprint. Again, like I said, subscribe to the channel, like the video, share it with someone that you need that needs to know this information, and let's continue to progress forward in our financial journey. Love you guys, man. I'll talk to y'all in a few days. Peace.